The Bitcoin network is changing in real time, and on this channel we're going to talk about what it means for Bitcoin in the future. What's going on, everybody? It's your boy JT, and we are back to the Crypto Den. I want to thank you for tuning in. Today we're going to be talking about layer 2s in depth. So this is a deep dive into layer 2s, specifically from one of the followers that we have asking about layer 2s on Rock. So there's a tweet thread we're going to go through, and we're going to actually analyze the conversation with AI, show you what's going on with Bitcoin layer 2s in general. But first, I feel like you need to understand what layer 2s are, so you can understand how they function on Ethereum and on Bitcoin, and what the pros and cons are, what it means for crypto at large, that we're going into this more modular thesis as it pertains to blockchains. Before I get into that topic, for those who do not know, my name is Jake Tullis. I go by JT, and I run a digital asset hedge fund called Bleeding Edge Capital. We're based out of Cincinnati, Ohio, and if you want to learn anything about my background or what I'm doing, just click the little link in the banner. Now, layer 2s. They are a complex thing that I'm going to try to make real simple for y'all, and I have some really cool screens over here that I think are going to assist in your understanding. First, what I want to show you is the difference between a layer 1 and a layer 2 from an architectural perspective. A layer 1 is a massive amount. So this is everyone that's installed Bitcoin or Ethereum and has a computer either mining or validating the ledger. This is what creates all of these things. Bob's computer, Jim's computer, you get it. And there's 400,000 on Ethereum and over 1 million on Bitcoin. And that's what a layer 1 is. It's just a bunch of volunteers for profit giving up all their computers to the network by installing its software, and then the network uses its hardware the software is installed on to provide these things through a protocol that is the software you download. Layer 2s look more like this. So there's something to be said for layer 2s, that they are more centralized. There's a lot less validator nodes. They have their own nodes sometimes. What really you want to take away from this is the layer 1 does not stop existing with a layer 2. Layer 2s are a different kind of user of the original network. So in Ethereum, there's hundreds of these things. Arbitrum, Optimism, Base, ZK Sync. There's just like plenty of these things. There's like a plethora. Essentially, Bitcoin is getting to the same kind of situation where you're going to have all of these layer 2s. They are going to be more customers of the network, no different than, a user. So there's this pool of people that buy the block space, and then there's all of these people, all of the users. They have their own fee pool on Ethereum. So these different pooled people or users, these types of customers that buy block space, they're different because layer 2s actually take some of these functions away from the layer 1 on the execution. That's the biggest one. Execution is an actual computation, like, hey, user A is sending X amount of ETH to user B, or X amount of Bitcoin. The network charges its native token, Ether or Bitcoin, for that computation, for whatever you're asking it to do. A smart contract call, it doesn't really matter. And that execution is what earns the revenue for the layer 1. This is where the problem becomes. Layer 2s actually do the execution, okay? That is a big thing that layer 2s are taking from layer 1s. They are taking the execution off of the main chain. So what they do is you transact off chain. These guys are doing stuff not on the layer 1. They're over here in layer 2 world, and they're doing all of their stuff here. Every 15 minutes, 30 minutes, an hour, 10 minutes, every layer 2 is different. They bulk all of this activity and then submit one packet of data for that entire 10 minutes. So they basically have an epoch, once an hour, 4 times an hour, something like that, 6 times an hour. And then they submit to Ethereum for settlement, security, and then this data availability piece isn't always the layer 1 even, which is more revenue for the layer 1. Sometimes this ends up in a third-party DA layer like Near or Celestia. But we use the layer 1 as layer 2s for security and settlement, meaning every 10 minutes I'm going to post your transactions on Ethereum. So they're there. But we're doing all this stuff off chain. And this causes a lot of pros and cons. Pros, it's much faster, which we're about to get into specifically for Bitcoin. Cons, it's more centralized and less secure, and it leaches value out of the layer 1, which is an important thing to make note of, genuinely. Now, hopefully layer 2s make a little bit more sense To summarize it in a sentence, layer 2s take execution off of layer 1s. They do it all off chain and it runs alongside a layer 1. That's it. That's what a layer 2 is. Now, specifically, one of our followers here had a conversation with Grok, just Michael96. And it was brought to our attention that, maybe we should have a video on this. And I thought, well, why not? Real quick, he's trying to understand what Bitcoin can handle. And that's not a typo. Bitcoin can do 7 transactions per second. That's not great. Bitcoin mainnet, not better. Slightly better, 13, 14 on Ethereum. But on layer 2s, you can get a lot more, right? Because it's a completely different thing that's upgraded, modified, running alongside, and it just submits its transactions in bulk, right? As one order, one packet to the layer 1. So they can get a lot faster. This is kind of the target that we're going for. This is the current, I guess, TPS a network would need to support all of the transactions that occur in a ecosystem. I thought this was a really interesting question. Essentially, can Bitcoin handle this many transactions in a manner for affordable fees? Like, can it actually happen? Grok said Bitcoin's base layer can't handle 54,000 TPS, but Lightning scales of thousands, potentially millions of transactions per second off-chain with fees under a cent. Congestion risks remain for on-chain settlements during peaks. For sheer speed, Solana 65K or Ripple 1.5K excel in high volume payments, though they trade some decentralization for it. By the way, so do layer 2s. That's another video. It's really important to understand that Grok is saying Lightning Network could scale Bitcoin to a massive, we could be doing DeFi on it, we could do stable coins on it, we can basically turn Bitcoin into Ethereum using layer 2s. That's the vision, that's the dream, that's the Bitcoin renaissance, industry. That's what everyone wants to do. That's basically what we're trying to figure out. Does it work? Lightning, does it work? Is this something that could actually happen? Grok believes that it is a layer 2 built directly on top of Bitcoin's layer, as we talked about earlier. It functions entirely with the Bitcoin ecosystem using payment channels anchored to the blockchain for off-chain transactions with on-chain settlement for opening, closures, and disputes. It doesn't rely on a separate network. Michael wanted to know, is this functionality present since Bitcoin's inception? If no, then how is it possible that Bitcoin's programming upgraded to allow layer 2s? So this right here is something, we're going to go back to the screen in a second. This is something I really want you all to understand. Layer 2s exist on Ethereum because Ethereum was built for that. It is a smart contracts platform from inception. The reason why Bitcoin can do layer 2s now is because it took computer scientists, developers, and researchers over a decade to find or think of a workaround to Bitcoin's core protocol. Now, I have some stuff to show you, but in general, I call it an exploit. AI thinks I'm being dramatic in calling it an exploit. But there is a specific part of a Bitcoin block. So inside of the block, there's components of how data gets submitted. There's a header, a body, a footer, in a messaging system. Okay, so there's 4 components. That messaging system, UTXO, is where layer 2s are submitting their data. So this original messaging system was just between the nodes, the miners, and it's just to let them know that the block was checked. So what we're doing is we're cramming Merkle root trees, which are how layer 2s really submit a bunch of data really cheaply and efficiently. It's an encryption method. So we're putting these long strings, is what you got to think of it. Just long things that could be submitted to the blockchain inside of a block that represents a host of transactions off-chain. Again, AI thinks I'm being dramatic, but the core of Bitcoin Renaissance is built off of an exploit or manipulating a part of the Bitcoin block just to allow for more data to be submitted. And miners are approving it or allowing it, and specific miners. So this is not something that Bitcoin was engineered to do. The core protocol hasn't changed. We are simply using a workaround. If you were a researcher, you would not call it an exploit. And I guess neither would AI. But if you were to talk socially with people and describe what you were doing outside of this context, it would be an exploit, in my opinion. I have over a decade of software experience, and this feels like shaky ground. I want to preface all of this with my opinion. Now, personally, as a disclosure, my fund is invested in STX. I personally am invested in STX. I think it's one of the best teams attempting this. So I could be wrong. But in general, I don't want to miss the boat if I am. So I have a small allocation towards one of these protocols that are doing this. If we go to the screen, you're going to look at my interactions with AI and some sources. These are not considered an exploit by AI. They do a good job of explaining it with a little bit more detail. So we already covered how they work. The reason as to how they work, it's a lot more scalable. Every single person down here is competing for block space, and then every single computer has to update the ledger every 10 minutes a block is completed. And we're all competing in basically a mempool. All the transactions are getting done sequentially. And it can only do 7 transactions a second, 10-minute blocks. That's why fees get really high. Over here, that doesn't really apply. It just doesn't. They're logging it in longer time frames. They're not charging you anything, right? Outside of a small fee, which they profit significantly on. And then they basically take all of your fees, pay maybe 5. I mean, these are 93% gross margin businesses. So literally 5, 7, 10% max to pay Bitcoin for the block space. And they're just cramming all of the transactions into that block. So it allows it to scale a lot easier and have reduced fees. And then since you can build your own layer 2 with its own execution, you can basically build smart contract functionality. You could just repeat what's already being done on Ethereum and is successful, right? Because it's its own independent thing, and it doesn't rely on Bitcoin's layer 1 to execute or implement any logic of any kind. But these are things to consider. So since it's a separate thing and it's more centralized, it would be real easy to get 6 out of 9 validators to do something it shouldn't on the layer 2 and submit it to the Bitcoin layer 1 as an example. So that could be a risk to any layer 2. It is way more centralized than the layer 1. Another thing is if you're trying to essentially build smart contract functionality on top of a workaround on the Bitcoin network, there could be increased likelihood of more vulnerabilities for whatever you build on top of Lightning. Lightning has had a lot of years of development. They have come a long way. I've heard better and better things from developer friends, but in general, you are duct taping solutions into Bitcoin. Outside of that, this is actually kind of a cool thing. So like Chainlink's actually working with the Bitcoin layer 2 ecosystem, and they had a really cool chart I wanted to show you guys before I get into my thoughts on all this. There is a strong correlation to network growth and Chainlink. That's why I invest in Chainlink, and I'm a Chainlink bull completely. I just thought this was really interesting for you guys to see. And they are actually working with Bitcoin layer 2s. Essentially, they function the same as Ethereum. They're saying all the things that I'm telling you. Oh, and there we go. And then, okay, yeah, this was there it is. So the risks, basically they're saying nothing has really been built out and implemented completely. It's kind of interesting that Ledger's actually using stacks, which is actually really cool to see. But also, like, there are higher risks due to the nature of these layer 2s. Lightning's been around, I think, since 2017-ish. In 22, an unattributed payment routing failure due to a bug. So there were faulty nodes. Again, these are more centralized, and it went without being noticed. Where if you had if you were on the layer 1, you had 1 million computers checking the state, obviously it would have been discovered, and we've never had an issue on Bitcoin with this kind of stuff. So, ultimately, Bitcoin layer 2s are good for the layer 2s. I think they're net bad for the user, because if your stuff is in a Bitcoin layer 2, it's not getting on a Bitcoin layer 1 chain the same way that an Ethereum layer 2 would be. That's the first thing. And, secondly, Ethereum was built for layer 2s. That is not true for Bitcoin. Bitcoin is engineered to be a pet rock. That's what it is. It is a pet rock. 7 transactions per second was the best they could do at the time it was built, but ultimately is a feature, not a bug. All that means is you're just going to be doing highly valuable transactions. You don't mind waiting 10 minutes when you're used to waiting 2 weeks. If I wanted to move $1 billion of liquidity and I wanted it to settle and I wanted it all to go well, you genuinely want to wait weeks, where I could send you that exact amount of Bitcoin and it's done, inside of 10 minutes if you were doing those kinds of transactions. The only reason you would do that is is to hold it. Look at all these treasury companies. Look at Sailor. Look at BlackRock. They're not doing anything with their Bitcoin. They are sucking it out of exchanges and they are holding it like they're supposed to. And these are the smartest people in the world playing the largest game of high finance you could ever play. It is a pet rock. You will get to millions of dollars a token without DeFi. And I think the user would rather be able to bridge assets easily, safely, securely, with confidence. I think they would prefer to do their DeFi stuff in an ecosystem where all that stuff has been built and used by millions of people for over a decade, like on Ethereum. I think this really is only a win for the layer 2s because it is such a profitable business. You can basically get millions of transactions, charge per transaction, be way cheaper than Bitcoin, and then pay literally 5% of your revenue to Bitcoin for submitting the data. It's an incredibly profitable business. I really think the only winner here is the layer 2s. And then you also have to consider that these layer 2s are going to be congesting the network with their activity in addition to the users. So Bitcoin's main function being expanded on top of a workaround, I call it an exploit, just seems like a bad move in general, in my opinion. I think it corrupts the idea of Bitcoin. Now, in terms of will it materially impact Bitcoin, I do not think this stuff is going to tank Bitcoin. I do not think it's going to negatively impact the network long term. I think it will be a side quest for the Bitcoin maxis that would prefer to have an NFT on a Bitcoin layer 2 owned primarily by a company, which seems against their thesis of decentralization, but I'm not here to throw stones here. I'm just saying this is a side quest that could blossom into something more and push Bitcoin higher, or it is neutral. So this is generally not a bad thing. I just personally am not a fan of what's going on. And I think I would personally not build. I might take a 2% flyer, which is what I did on Stacks, which I think is the coolest of them all. Lightning just has a lot of baggage and tech debt they've had to reprogram out of. I don't know. Lightning was first to market. You can't get a token on Lightning, so I can't get exposure to it. I would probably have done 1% in each if I could have, but I really do like the Stacks team and what they're doing in terms of if you believe in this fully and you're going to build this, I think they're doing it the right way. If you like content like this, hit the sub. I bring nothing but unfederated thoughts and opinions to you all to help you understand this asset class and better navigate the waters, because it is volatile, it is choppy, it is intense. But this is, in my opinion, the coolest industry and the best place to be putting my money. All right, until next time, take care of one another. Peace and love. I'll see you.